Hello everyone. So now we're moving into Module 2. We're coming down from a conceptual level. Module 1 informed us about what the environment looks like, the why, the how, the idea of how we would do certain accounting records, why we would record them at certain values. It underpins everything we do. Now we're going to dive into the mechanics of the process with the accounting cycle. We're going to talk about adjusting entries. We're going to talk about closing entries, financial statements. So this is the execution, but remember, you got to know the stuff from Module 1 because without that knowledge, without that story, the execution just becomes a set of arbitrary steps. So the very first step of this process is journalizing. And we use a general journal in accounting. Typically now this has moved to software where we have a program that will help us record a chronological listings of all transactions that occurred during a period. So a chronological listing is ordered by dates and time. So if you have a customer come in and you make a sale at 8 in the morning on August 21st, then that would be your first transaction. You would record it, you debit cash, you credit sales revenue, you debit cost of goods sold, you credit inventory, all at 8 o'clock in the morning. Then you have a delivery that you pay for, and maybe it's a delivery of inventory. So now you just bought some inventory from another company that you're going to stock your shelves with, and it's 9 o'clock. So that would be your next journal entry because you would debit inventory and credit the amount of cash you paid. So it's chronological and it's things that occurred during the period. The general journal has to record dates of transactions, and if we're getting even more granular with what the chronology is, then we'll also have the time of the transaction, the amount and the account that we're going to be debiting and crediting. And so it follows that format that I presented at the end of Module 1. It's Module 1.2, Part 4, where I show you how I want journal entries recorded. So make sure that you do include the date. It helps clarify some things in your mind. Also in grading, there'll be some moments later in class when we record the transaction might not be totally straightforward. So it's extremely important to keep track of that. We also might include some subsidiary journals. That would be, smaller subset journals where we keep track of additional level of detail. Two primary accounts that we might do this for are accounts receivable and accounts payable. These are in addition to recording in the general. So journal and the subsidiary journals. And the reason why we might record this at a more granular is that in the general journal we might just debit accounts receivable, credit sales revenue, but in the subsidiary journal we would be a little more specific and we might say account receivable, and then we would list the customer who is owing us money at this time. So say I bought something on account with an organization and they would debit my account specifically, and then they would record sales revenue from that account. So it just gives us a little better idea of what's going on. All right, so we make this journal, and you would then probably, software does it for you all the time. Really, anytime you record a journal entry, I jump into the ledger, posting items to the ledger. It's a summarized listing of all accounts. So we have a chronological listing up here. Now we're starting to list them by accounts, totaling each account. So we might have multiple debits and credits to cash, but they could be spread out because they didn't happen one after the other in terms of time. So we might have one debit to cash at 8 o'clock in the morning. Then we have a bunch of other transactions that don't involve cash that would fall out in the general journal because they occurred in time. And then say at 10 o'clock, we have yet a new cash transaction, a credit to cash because we bought something. And then some non-cash associated entries. And then we had another debit to cash later on. So it starts to organize things by account rather than by a chronological listing, which is important and gives us a different organization of the data that we've collected. We're not bringing in any new data. We're just organizing it a different way. In class on assignments, a lot of times you'll use a T count to reflect all journal entries updated as they read. And so, for example, with this account receivable and sales revenue that I just made up over on the side, I would then have account receivable debited for X dollars. That shows me that piece, and then a sales revenue update to my T account that would then collect the sales revenue information and put it on the credit side of a T account. T accounts are extremely important when you're working through problems, especially when we start getting into the later modules, exam 3 and exam 4 and exam 5 material. Or I said not exam 5, but the final, because then you can start seeing, if you have multiple journal entries, how the accounts and the account balances are being affected per each account. So the general ledger is made up of two types of accounts, and they're not ordered necessarily by types of accounts, but it's good to know these two types of accounts. There's what we call the real accounts, which are sometimes also called permanent accounts. These accounts are never closed at the end of a period, and they are accounts we find on balance sheets. They roll forward into the next period. So whatever your ending balance at the end of one quarter is, would then be the beginning balance of the subsequent quarter. Or the ending balance of a year is the beginning balance of the subsequent year. Then you have temporary accounts or nominal accounts, and these are closed at the end of the accounting period. These are the accounts that we apply closing entries to. And typically these are income statement accounts, and we also close dividends that we pay to our owners. So on top of this, and I discussed it a little bit again in one of the final videos in Module 1.2, either accounts be normal debit accounts or normal credit accounts, and this designation is based on whether debits increase the balance or credits increase the balance. If a debit increases the balance of an account, then we have a normal debit balance. If credits increase the balance of an account, then we have a normal credit balance. If you look at the examples of the two accounts I have below, this just shows, say that this one is a real account, and then we would put the title here. We'd have our T account. It has a beginning balance because it is a real account. That beginning balance was the ending balance of the prior period. Then we had some transactions that we journaled. We had a debit to this real account in one transaction, and then a credit to this real account in a separate transaction. And then finally, we would reconcile the account. 10,000 plus 35,000 would become 45,000, but then we credit it by 28,000. That would reduce it to 17,000. That becomes its end balance. Because we don't close it, that end balance then becomes the new beginning balance, and it starts at a debit at 17,000 in that subsequent period. If we have a nominal account, on the other hand, you'll see things are a little different. There is no beginning balance at the beginning of the period. And then let's say we had an adjusting entry. We'll talk about those in a second. But an adjusting entry debited this account, increased it by 5,000. Perhaps we recognized an expense at the end of the period through an adjusting entry. We debited an expense account, and then it ended up here. And then we closed this account as the one of the last steps of the accounting cycle with a credit that completely wipes it out. This is not a transaction. This is just an item that we do in order to report, and then that zeroes out our ending balance. And then I have also labeled adjusting entry and closing entry just so you're what those items are. So both of these are normal debit balance accounts, because here we have debits increasing the account, credits decreasing the account. The real account always carries a debit balance. There will never be, okay, just so you know, this is something I see a lot. There will never be a negative value in a T account or a journal entry. There's a reason why we stay away from saying things like, or we try to stay away from things like subtracting. We talk about increasing and decreasing. An asset account cannot become a credit balance. It just can't. Like, we can't have a credit balance for cash, because that would mean we have negative cash, which absolutely makes no sense. If we have negative cash, that would, the only logic behind that would be to say we owe someone money. And if we owe someone money, that's not a cash account thing anymore. That's a liability account. And the same thing for any sort of account, like a normal debit balance account, that's an expense account. An expense account is a nominal account. It's something we close. Expense accounts cannot have a credit balance, because that would suggest a negative balance. If you feel inclined to use a negative number, like you're saying in here, you mistakenly have like negative 35,000 cash debit, then that probably means that what you're really wanting to do is credit that account for 35,000. So just be careful with that. Understand that there are no negative values when we're doing journal entries, T accounts, and also trial balances. On top of the real nominations, there are two types of accounts, adjunct and contra accounts, and both of these only exist when they are attached to a parent account. Otherwise, they make no sense. So let's look a little bit more at those and what an example of those are. Balances of these accounts are deducted from the balance of the parent account when reporting on a financial statement. So here we are subtracting, or ultimately subtracting, which sounds like it might be counter to what I just said, but we're not subtracting within an account. Okay, we're looking at two separate accounts, and we're looking at the one account here, accounts receivable at 90,000, and we're subtracting off the credit balance of its contra account. So what are some examples of a contra account? The one I gave just below is a contra account. The allowance for doubtful accounts is a contra asset account, and it is contra to the accounts receivable account. So what does the allowance for doubtful accounts mean? It means, or if you defined it economically, what its purpose was, this tracks the amount of our receivables we do not think we'll be able to collect. So how could we have an account that we estimate we will be unable to collect unless we actually had an account to say, hey, that one's circumspect. We don't think that we're going to be able to get money from that customer. Another example that that is even more familiar, most likely, is accumulated depreciation, and that account's parent account is a fixed asset account of some sort, machinery, equipment, or buildings. And again, it makes no sense to have accumulated depreciation unless we have it tied to an asset that we are matching the expense of over time. So, contra account, one of the hallmark rules of a contra account are the rules for debit and credit are opposite of its parent account. So here we have accounts receivable, which is a normal debit balance, and we have allowance for doubtful accounts, a contra asset tied to accounts receivable, and the way we increase it is with a credit. So it's a normal credit balance account. Why do we keep separate track of these things? In the ledger, they are two separate accounts. they have two separate T accounts. When we journal these items, they are separate accounts. The only time they are combined is when we report on the balance sheet. So here's when we combine all contra accounts with their parent accounts. And that only happens when we present the financial statement. So when we present on the financial statement, we would just say the book value of receivables is $85,000. That is, we take the $90,000 debit balance that is in accounts receivable, subtract off the $5,000 credit balance in the allowance for doubtful accounts, and that gives us the accounts receivable balance. I'll pick up in the next video and we'll talk a little bit about adjunct accounts. This verbiage just goes through what I just talked to you about and explains some of the symbols that I have going on in the example above.